Hello everyone, I am Dr. R. Jeyalakshmi, Assistant Professor of Commerce in the Standard 5X Rajarathinam College for Women, Sivagasi. Today we are going to discuss about bank lending principles. Let us see the introduction of bank lending principles. The main sources of funds available for lending for a banker include paid up capital, reserves, deposits in other accounts, borrowings from the Reserve Bank, participation certificates and distribution portions of the current year's profit, refinance loans from the Industrial Development Bank, Agricultural Refinance and Development Corporation and other financial institutions. These are the sources of finance for banks to provide loans to the needy persons. Let us discuss about the principles of bank lending one by one. The first and foremost principle is safety. Safety is the most important principle of bank lending. A bank must ensure that the borrower has the capacity and willingness to repay the loan on time. The banker carefully examines the borrower's income, credit history, business performance and character of the borrower. Loans are usually given to financially sound and trustworthy borrowers to minimize the risk of bad debts. The second principle is liquidity. Liquidity means the ability of the bank to convert loans into cash whenever needed. Banks prefer short-term and self-liquidating loans so that the funds can be recovered quickly. This helps banks to meet the depositors' withdrawal demands and maintain smooth operations. Long-term loans are given cautiously to avoid liquidity problems. The third principle is principle of profitability. Profitability refers to the bank's objective of earning income through lending. Loans should provide adequate interest and service charges to cover operating costs and risks. However, banks should not compromise safety while seeking profits. A proper balance between risk and return is essential. Security. It acts as a protection against loan default. Banks usually ask for collateral such as land, buildings, gold or other valuable assets. If the borrower fails to repay the loan, the bank can recover the amount by selling the security. Though security is important, it is only a secondary source of repayment. Purpose. Banks must ensure that loans are granted for genuine and productive purposes such as business expansion, agriculture, education or housing loan. Housing loans can be given to the needy persons. Loans given for speculative or illegal activities are avoided. The purpose of the loan determines the amount, period and terms of repayment. Diversification of risk. To reduce risk, banks avoid lending a large portion of funds to a single borrower, industry or region. By spreading loans across different sectors and customers, banks can minimize losses. Diversification helps maintain financial stability even if one sector faces problems. Stability. Banks prefer borrowers with stable income and steady business operations. Stability ensures regular repayment of interest and principal. Businesses with long-standing operations and good market reputation are considered safer. This reduces the chances of default. Principle of marketability. The principle of marketability means that the assets accepted as security by the bank should be easily saleable in the open market. In case the borrower fails to repay the loan, the bank must be able to sell the security quickly without much loss in value. Securities like government bonds, shares of reputed companies, gold and easily marketable goods are preferred. High marketability ensures quick recovery of funds and reduces the risk of loss to the bank. Therefore, banks always give importance to the nature, demand and resale value of the security while granting loans. The last principle is national interest. The principle of national interest means the bank should give loans in a way that supports the overall economic and social development of the country. Banks are encouraged to provide credit to priority sectors such as agriculture, small-scale industries, education, exports and self-employment. While granting loans, banks avoid financing activities that are harmful to the society or against government policies. By following this principle, banks help to promote balanced growth, employment generation and economic stability, thereby contributing to national development. There are 9 principles of bank lending. So, hope you all understand this concept. Thank you, one and all.